I think they're also trying to open up. And then when I tried to analyze one of the buyers in Austria called ESA, during the lockdown, their sales increased. They're doing fair trade and organic certified coffees. From their sales increased because they turned into marketing online the product, and people were able to consume coffees at homes. Yeah. So when other people are calling, when people were alarming on the effect of COVID because of coffees not being sold, for them it was the opposite.
Yeah, that's right. Austria, same in Germany, by the way, even a much larger market. Their sales of these certified coffees also largely go to at-home consumption through supermarkets. And now what you explained, a lot is sold online. So they're not affected. They even benefited from this. That's okay. Now, for whom is what happens in those main exchanges really important? Or do you depend more upon, like, these certified coffees to have a certain distance to the market, although it depends on the price level? Or I saw some comments on that as well. Or you're mainly focusing on the local market, and we just heard that in the case of the local market around Mbale, they've got their own dynamics. It's at a certain distance from what happens in these terminal markets. What's your situation?
My situation, I happen to have to do international business.
Yes.
Yes, I happen to do international business. I supply to Europe and USA. There are quite a number of things to take in the international market. One, the price in the international market directly affects the certified product, because I mean, you're majorly dealing with the certified product. If the price is above 140 cents, the demand for coffee increases, because it means the conventional market and the certified market is going to sell coffee at the same price, almost the same range. So there's also equally high demand for certified coffees, especially fair trade, whose price has a minimum price of 140 cents. It means if the other conventional coffee is costing 140 cents and this is 140 cents, it means the price is okay, and means the competition is high. That means you can be able to sell the fair trade certified product. The consumption is equally high, simply because the mainstream coffee is also costing at 140 cents. That is one. Two, if the price is high to around 150 cents, it means for the certified crop, I'm able to sell at 150 cents, creating an extra 10 cents for the group.
Mm-hmm. Yeah, I understand the argument. It is true that when the market is very low, fair trade certified coffees, because of this minimum price, are relatively expensive, and the demand is not growing that easy as other certification like oats or rainforest. But it also depends upon which market you're selling. In most of European countries, large buyers, like for example Germany, the consumer is very price. They very much focus on the price. They know very well what prices they're paying. So there's a limited capacity to grow if you have rather expensive coffees. But in many other countries, for example, in the USA, the demand is much lower. But people who do buy it, they don't really look that much at price. If you look at the specialty coffees in the fair trade certified coffees, etc., they're anyway very expensive in the US. So people don't look that much at it. So it really depends on which market you're targeting, whether price really makes a big difference or not. In other markets, they look more at how you sell it, how you promote it, cup quality, those kind of issues. So
yes,
you need to distinguish between the different markets.
Then secondly, on the other side, locally,
yes,
when you when you look at the local scene, when the international market increases, there is very high competition for coffee on the local market because multinationals injecting a lot of money. So for us who are small producers, much as we have loyal farmers, sometimes they are tempted to sell their coffee to the multinationals. So that way, small producers lose out. SMEs with smaller economic muscle lose out because the multinationals now buy at a very high price. Now, vice versa is true. When the price is low, that means the multinationals, because they're doing conventional coffee, they're able to buy at lower prices, giving certified companies a better competitive edge in the local market to buy from the producers.
Okay. Anyone else apart from Frank would like to contribute to this discussion?
Open your email.
Alfred. Aurelian.
There's no more opinions upon that, the first two questions. Now, comparing the price scenario for 2021 with that of last year, what does it mean for you in terms of volume, profit loss, need for finance, and in terms of risk? And are you prepared for that, or what do you miss? What do you think will be different this year from what happened last year, in other words? Who would like to contribute to this?
On the chat, I think Lillian was trying to respond to the first question, and is saying that her microphone has a problem, but she was saying, I see coffee prices going up due to increase of coffee consumption as easing of lockdowns in major consuming countries takes effect. That's from Lillian. Okay, that was.
Yes.
Let's proceed. Yes.
Yes. Okay. Well, if our analysis is right that price is most probably going to increase this year, of course you will need more finance. We heard already from Frank and from others that if price go up, local market also is going up a lot, and there's a lot more competition, particularly with the large exporters, the multinationals. So your profit, your margins will be under pressure. And normally when price goes up, it's a lot more volatile as well. Price fluctuations are much stronger, so the risk is also increasing. But the other day I saw an analysis that the large funds are somehow reducing their participation in this market, and that could reduce the volatility of the price if there is less speculation in New York and in London. But particularly in New York, it could be slightly easier to manage. Frank, you wanted to say something?
Yes. There are high chances of trading more volumes because of the demand, especially that there is low production in South America. It opens a window of hope to Africa. That means, like you said, the risk is quite high. It means you're going to invest in a lot, and the profit margins are likely to drop. and the risk is quite high. But this is what brings in the aspect of critical analysis of the figures and map your journey well, and see if you can use financial tools to hedge the position of the organization of the SME, so that you are not real so much exposed to the risk. Otherwise, it might have serious consequences.
Do you hedge?
Yes, you can look at hedging options available.
I know you can, but your organization, are you using hedging tools?
Yeah, we are using some hedging tools. One of them, like currently, we are suffering with the appreciation of the Uganda shilling.
Yes.
If I forecasted to get a dollar at to exchange a dollar at 3,750, right now I'm exchanging at 3,000. People are exchanging at 3,620. Others 600 flat. So what we did is to negotiate for what we call a forward rate to last for 6 months, to give us at an exchange rate of at 3,700 flat for 6 months. It's what we are benefiting from right now.
Okay. So you did some forwards with your exchange rate?
Yes, with the bank.
Okay, that's good. So at least you're excluding that risk. You're building in a
Hello.
It's now clear, we can hear.
Frank, are you listening? Are you hearing? Yes, are you hearing?
I'm hearing. I'm hearing.
Are you all hearing yours, or it's just us? Maybe we are missing out on yours.
I've heard you.
Ask you. I've sent him a message. Hello? Hello?
Hello?
Hello?
Yes, yes. Yes, yes.
Consultant. Kufikiri mwenye wada? Watu wasema kutuwasilisha.
Hello? Hello? Participants, we are trying to sort out. We are trying to sort out something from yours so that we can ably hear him. Listen.
Can't you hear me? Now you can.
Yes, now we can hear you.
Finally.
Yeah, now we can. Yes, now we can.
This is a disaster. Sorry for that. I've been logging in a couple of times now, but anyway.
Yeah.
Now it's working. Okay, I'll try it again. And sorry for all the inconvenience, but this has been quite challenging. Where is this? Logistics. Can you see my screen now as well?
Yes. Yes.
Okay. Well, there we start finally. Sorry for all this. Okay, we're talking about contracts and contract negotiation. To negotiate, the first thing you need is to know what you've got to offer and what's your capacity in terms of volume, grades, coffee, delivery in time, etc. And you need to compare yourself with your competitors and only offer what you can really guarantee. That's really a basic thing. Know what you got and only try to sell what you can guarantee. Well, depending upon what you can offer, you have to decide into what market segments you want to sell and to what kind of buyer. There are many options, but you may not have access to all these options. But it also depends very much upon what you can really offer. Local sales are easier. Export markets offer more options, but require more capacity and knowledge, and they imply higher risks, and they also demand more finance. To get a new buyer, you have to show your organization's track record in the business, a brief presentation with basic information of your organization and samples of the grades that you offer. But the information must be precise and concise. I often see very large stories about organizations trying to sell their image and their coffee, but traders, they don't have much time for it. If it's one sheet, it should be more than enough to summarize who you are and what you do and what you offer. Then you need clear objectives and targets for the season, and in each negotiation, value what it contributes to the overall plan and to the margin that you want to make. You need to review it constantly. Offers need to be precise and concrete. Volume, what grades you're offering, what price you're asking, what shipment months you've got your coffee available, etc. And if you make a firm offer, you have to indicate until when you sustain that. Meanwhile, you can't offer the coffee to another buyer. Selling is not just signing a contract, but also giving a proper follow-up until the whole process is finished. Inform the buyer about progress and feed him with information. Get feedback also on the quality of the product and on the quality of the service that you are providing. Monitor your short-long position permanently. Short-long, for those who haven't participated before, refer to short if you sell the coffee, you don't have it yet, you sell it forward. And long means that you've got your coffee in store, but you haven't sold it yet. But don't sit on your coffee. You need to rotate. The business is rotation. If you sell forward at a fixed price, make the period as brief as possible or take other measures to contain the risk. I've seen also in Uganda quite a few organizations who sell forward for weeks or months, and they absolutely are not protected against any kind of price fluctuation. If you sell forward, you're short, and your big risk is that the market will go up. You know what you sold it at, but you don't know what your cost will be. Yeah? And sell the entire crop at the beginning of the harvest may look attractive, particularly if you've got certain contracts like fair trade contracts, but it can become a disadvantage if the market conditions change. It's better to sell by batches and try to average a reasonable price. For example, if you do your fair trade sales now, when the market goes above 140 cents, the minimum price for Arabica, washed Arabica,
it can be quite challenging to be able to deliver. At the end of the season, you need to evaluate your performance and the results that you obtained. What elements of the process need to be improved, and how your offer can be improved, and what other sales options you have. If you want to improve your sales conditions, what you first need to do is improve your offer. Either you offer a better quality or a better service, more consistency in your deliveries, better compliance, timing, also your organizational profile, make it more attractive, communicate better, etc. Otherwise, you won't be able to improve your sales conditions. Also try to look beyond your direct buyer. Into what market segments does your buyer sell? What are the needs of the final buyer in terms of quality, information, etc. And adapt your offer to that, to what the specific needs are of the roaster behind the trader you are selling to. The more you move up in the supply chain, from a local trader sell to an exporter, from selling to an exporter to an importer, and even some try to sell directly to roasters, you have to substitute the functions of those who are in between you and that final buyer. You need to offer the same quality services, and that's not easy. If you try to export directly, you will have to provide the same service as any exporter in Uganda, including the big multinationals. Normally, the buyers have a stronger bargaining position, and it's a buyer's market because there is an oversupply of coffee. If there is more than enough coffee, they just sit and wait what is the best offer they can get, and as cheap as possible, of course. And in situations where there's a scarcity of coffee, that are not that common. So normally it's the buyer, but it's also because of the type of buyers that you got. If you look at the world market, there's only just 5 large traders who control 50% of all the exports of coffee from producer countries to consumer countries. These are Neumann, Louis Dreyfus, Ecom, ED&F Man, Wolcafé, and Olam. Those are the big traders. And they do have a lot of options. All these traders also have a department for specialty coffees, for certified coffees, etc. And because of the size and that they are in almost all countries working, they offer more options. But they also compete with you locally because they go directly to your producers for their coffees, and they compete with other buyers you have in consumer countries. So it's a bit tricky. Somehow you may need them because they offer the best options. On the other hand, they're also your main competitors very often. Nevertheless, even for these large traders, the trade margins are thin, and traders are under pressure from the roasters. The roasters have a stronger position than these traders. For example, what we see lately, the last 2-3 years, is that the roasters try to extend the credit up to 360 days. Originally, it was 30 days, 60 days. That's normal as a supplier for a roaster that you give them credit. But now 360 days, that's even for these large traders, a lot of time, a lot of money, and they've got limited credit lines with their banks. A lot more than you need, but like Olam, they negotiated 2 years ago a package of $860 million with a syndicate of, I believe it was 17 banks involved in that. But they're under pressure. The main clients demand up to a year credit. And all this pressure, they pass it on to the next one in line, and that's, at the end, it's the producer. So you see a lot of producer organization suffering from this pressure that they get paid very late, etc. A growing number of small traders also are starting to buy coffee in origin, especially the higher quality coffees. And they buy directly from farmers, offering very high prices often. And they are competing with co-ops over the membership. So that's also something you need to take into account. They pick out the best coffees of the harvest. They don't buy all the coffees, but they do distort a lot the local prices there. Now, talking about the different clauses in the contract. Normally, sales contracts are written out by the buyer, and they contain clauses that are meant to reduce the risk of the buyer. But those clauses may affect the seller. So you need to review the clauses and analyze what possible consequences they may have before you sign the contract. If you are doubting, you have to clarify these doubts and ask to amend a clause if necessary. But don't sign blindly and start only acting when problems occur. I know that a lot of producer organizations, they're very happy when they finally have a contract, because it's not easy to find one. And often you need a contract to get finance as well, using the contract as a collateral. But check what the contract says. Be careful not to sign something that may cause trouble afterwards. Make a list of different concepts that appear in the contracts and what they mean. Many things can be, you can find it in the coffee guide. There's a link to that of the International Trade Center. So check all the concepts that appear in the coffee. For export contracts, there are the European Contract for Coffee, ECC, and the contract of the Green Coffee Association, or GCA, in the USA. These two contracts deal with most of the contract conditions. What are these? Quantity, weight, and packing. There's a lot of detail in those two contracts. Everybody's looking at and referring to. Quality, how you deal with quality. Freight and insurance. Documentation and communication. Licenses, certificates, duties in different countries. Payment. Defaults, claims, force majeure, arbitration if necessary. It's all regulated in those contracts. And also the inclusion of international laws and conventions, because these are overruled by these specific contracts for coffee. They're much more specific than those general international conventions. Now here you've got links to these different contracts. European Coffee Federation, the Green Coffee Association in the US, and the Coffee Guide offers quite an interesting summary of all this. Export contracts between buyers and sellers are generally very concise, limited to only the particular conditions of a transaction, because the rest is dealt with in those two European and US contracts. So what you normally see in a sales contract is quantity, weight, packing, the type of coffee or the grade of coffee, price, or it's not a fixed price, price fixing conditions, shipment conditions and Incoterms, payment conditions, handling of documents, sample approval, and certification requisites if applicable, if it's certified coffee. Arbitration. So you see passing by a few examples of contracts. Normally there's just one sheet. Some have 2 or 3 pages, but most of these contracts, just one sheet with only the basic information for a particular transaction. After signing the contract, it is common practice that the buyer sends shipping instructions with more details at a later stage. Things such as destination, contract may be open in that sense, because they still don't know when they contract the coffee where they will be selling it. Shipping company, date, even the vessel name sometimes is indicated. Marks on the bags, documents that are required, etc. In the next session on logistics, we will be looking more into the details of this. Delay in the shipment may lead to the washout of the contract, or more common, to a fine. If a contract says June shipment, it ends on the 30th of June. If you ship it until July, formally you're in complying a contract and they can cancel the contract. It's not what most of the buyers do. They will be trying to find a solution, but you need to indicate it in time that you will have delays before it happens, not after. Yeah. In fair trade standard, they even define that it must be at least 2 months before shipment date that you inform about possible delays. And this is necessary for a buyer because they've got commitments as well. They will have to deliver coffee to their clients, to the roasters, within a certain period of time. Some roasters are very strict on that. I know a roaster who asks for delivery within 8 days. Every week he receives the coffee that he needs for the week. You need to be aware that the roasters also are very conditioned by the supermarket. Many supermarkets have a demand of compliance of at least 98%, which means that in 98% of all deliveries, they need to be in time, the right quantity, etc. If they fail on that, the supermarkets fine the roaster. The roaster will pass it on to the trader to the supplier. But the worst thing that can happen if you fail with the delivery is that you lose your client. Buyers may present weight loss claims, quality claims for damaged cargo, but only up to a certain deadline. In those contracts, European and the US contract, it is defined what's the time limit for that. In case of a claim, ask for evidence and review internally on what conditions the coffee was shipped and what might have happened during the shipment. To negotiate a settlement, you need to get to an agreement. If you don't get to an agreement, you can go for arbitration, but that takes time and it's costly. And it's abroad, you need to travel to the country where the arbitration is taking place, etc. So it's much more preferable to reach an amicable agreement and preserve the relationship. Now here we've got an example of a contract. On the left, you see the concepts, it's quantity, what kind of coffee, what quality of coffee, the price, the condition, destination, etc. And on the right, you see a description of these concepts. So in this case, this contract number, yeah, it's about 320 bags of about 60 kilograms each, yeah, net each. It says about because it's not exact. Coffee can increase or lower its weight according to the humidity. There's a limit to that. In the ECC and GCA contracts, the limit, the tolerance for that, or the franchise they call it, is 0.5%. So you can only have a weight loss of up to 0.5%. Then you're still within the contract conditions. If it's more than 0.5%, they will send you a debit note for a weight loss. The description here is Uganda Washed Arabica Coffee Crop 2020. Yeah. Organic Rwenzori Arabica AA Cup 84 or better, maximum 8 defects. Yeah. It's very precise description of coffee. Price, New York, July position, plus 65 cents per pound. Price includes 15 cents quality differential, 20 cents fair trade premium, and 30 cents organic differential with a minimum price of 990 cents per pound. Conditions, FCA Mil Kasese. FCA means free carrier. Free carrier means that it is the buyer through the shipping company who is in charge of moving the coffee from, in this case, the mill in Kasese. So you sell the coffee, placed in your mill there. Destination Antwerp. Shipment is a 20-foot container, LCL, FCL conditions. On the left, that is in origin. On the right, that's in destination. In logistics, we're going to look more at these details. LCL means less container load. It means that you deliver the coffee, but the stuffing or putting the coffee into the container is done, in this case, by a company contracted by the shipping company. Yeah. Full container load would have been that you put the coffee into the container and then it's taken to destination. On the right, that's for where the coffee is received. Less container load means there that the coffee is unloaded in the port where it's received, put in the warehouse until they send it forward to a buyer. Full container load means that it's sealed and goes in a sealed container to the roaster where they unload it. Weight and tear, net shipped weight. Net shipped, the tolerance or the franchise is 0.5%. Date of shipment, this is June. It's an error, can never be 2018. It's from an old contract. Supplier, Wenzori Organic Farmers, Flow ID. This is a organization who doesn't export directly. There is a exporter here, takes care of shipping the coffee. This is the supplier where the actual coffee comes from. And payment, net cash against documents, which is just a few days after receiving the documents that the buyer is paying. Contract, European coffee contract, latest edition. And then complementary, it says price to be fixed latest 1 day before first notice day or bill of lading date, whatever comes first. Why this? This is very common. First notice day is the first day that a trader who operates, who hedges, in this case, a New York exchange, can be notified that he has got an open contract and he has to, in this case, take a coffee from the exchange. Now, they don't want any kind of generic coffee. They purchase a very specific kind of coffee, Worcester Arabica, Rwenzori AAA, Cup 84 plus, and it's organic. Yeah, that's not the kind of coffee that you have. So they want to close that position, and therefore you will have to fix the price before that first notice day. But if it's shipped before that, they will want to have it fixed by the time you issue the bill of lading, because the bill of lading changes the ownership from the supplier to the buyer, and the buyer, of course, wants to know what cost it has. Full set of documents, bill of lading, blank endorsed. It's not really interesting for you, but it's important to take that into account when you book this shipment with your shipping company. Freight collect means that the buyer is buying. Notify Fair Trade Enterprises. That probably means that it will be sent to a roaster. But this trader wants to be informed that the coffee arrives, so he can inform the roaster that it's on its way. Subject approval of pre-shipment sample, or SAS, subject approval of sample. It means that you send your sample before you ship the coffee to be sure that it's approved, that it meets the conditions that you agreed here. But it also says replacement. There you need to be careful. Replacement means that if the sample is rejected, you will have to send another sample of another lot of coffee. Now, if you are a small organization with only limited volume and you won't be able to guarantee the replacement with another coffee, particularly if it's towards the end of the season, don't sign this kind of contract. Ask the buyer to take out this clause, explain that you can't guarantee that, and you will have to get to some kind of an agreement. Normally what is done is roll it over into the next season. So if by the end of the season you try to ship your coffee and it's rejected, you will have to wait until the next season to be able to send a container load. But it can also be replaced by a NANS, no approval, no sale clause, which means that the whole contract is cancelled. Okay. Organic certificate. And then, this is also important, you sell it free carrier at a mill in Casesa, but it says that the difference between the cost between FCA Mil Casese and FOB Mombasa, 9 cents per pound will be deducted. So you get a minimum price 190, but that's FOB Mombasa. 190 FOB Mombasa is equal to 181 FCA Mil Casese in this contract. So each clause can generate a cost, and that requires evaluation. Price, if it's a fixed price, value the risk if the coffee hasn't been procured yet. If it's an open price, review if the price fixation is conditioned and what the deadline is. Sometimes there are conditions like you can't fix the contract 1 month, up to 1 month before shipment, which means that if the shipment is very late, you're sitting on your coffee without being able to fix it, and that implies a risk. First notice, they already mentioned it. Why? Or the bill of lading date. Quality and preparation. Always look at how much does it cost to prepare the grade that's required in relation to the price, and analyze the consequences for the rest of the coffee. This particular contract says it's cup 84 or better and maximum 8 defects. That's quite a high quality coffee. Now, if you have that kind of coffee, you're happy to be in a region where there is this kind of high quality coffee, you can do it. But if you really have to squeeze out all the best coffees from your all the coffee that you procure, and you're left with rather low quality coffees, maybe it's not that good to sell this coffee unless at such a price. Maybe it's better to make blends, sell it a slightly lower cup profile, 82, 83 or something like that, so it's easier to handle it. Point of shipment and sales condition, compare your cost and price versus other options. Take these into account when negotiating the price. Like in this case, it's 9 cents different. Could you get better prices if you sell it, put in Kampala, for example? The 9 cents is quite a lot of money. Net ship weight, already mentioned it, there's a franchise of 0.5%. And the contract may contain a range of complementary conditions that require careful analysis in terms of, is it feasible what they're asking for? What are the risks? What are the costs? Like, for example, the replacement clause. Packing, also analyze the cost, include that in the price negotiation. For example, nowadays, particularly for the better qualities, buyers often ask to ship it in grain pro bags. But those are expensive. It's a couple of dollars per bag. So if you accept a contract with that kind of condition, negotiate that into the price. Let them pay a slightly higher price because of these kind of additional demands. Cash again documents, it should take not more than some working days, maybe some delay if you triangle it for pre-finance. Monitor your payment date. Payment delays affect your liquidity, lower your purchase volume, and they increase your cost. So be careful with that also. It should be paying in time, otherwise you may be in trouble. Subject approval of sample is fairly standard, but replacement, I already mentioned it. Be careful with that. Then some even put a clause which says that it's subject approval by the final buyer of the arrival sample in destination. That really eliminates your option on an arbitration if you don't agree. And you're at the mercy of the final buyer. You may not even know who it is. You haven't signed a contract with that final buyer. So don't accept those kind of conditions. You've got an agreement with your buyer, he will have to stand for it. Yeah. What he does with this buyer is his problem, not yours. Local sales contract may be concise like export contracts, but they may also contain a large number of clauses on issues that are covered normally in these European and US overall contracts for exports. I've seen local contracts of 10, 12 pages, all kinds of details. Many buyers sign two types of contracts. One for the general conditions during the season, which is very similar to the European and the US conditions. But with the type of coffee, total volume, and the delivery scheme. So it's kind of during this season, I will be doing 200, 300 tons of coffee, different batches. These are the general conditions. But then for each delivery, they issue another contract with the specifics of that transaction, which is similar to an export contract, a simple agreement. Referring to the export contract clauses, local sales contractors need to define the following conditions, additional, limits on volumes and delivery dates. To what extent are you allowed to deliver coffee? Place and the conditions of delivery. Where do you deliver that coffee? And under which conditions? Price, or how the price will be established. What presentation the coffee is delivered and paid. Is it in cherry? Is it in wet or in dry parchment? Drucker, Kiboko, FAQ, export grade, whatever. Grade and the maximum defects that are allowed. Transport costs, who pays for what? Processing costs, if you sell it for exports later on. Sales costs, if you export it later on. Yields and conversions, you deliver in, for example, in parchment or in Kiboko, but what are the yields that are expected? Now, do you convert that to a export grade, for example? Default sanctions, if you don't deliver in time, don't deliver the right quality. And loan pre-finance conditions, if the buyer is also paying ahead. And the instance and place of arbitration. These are important additional elements for a local sales contract. Now, for fair trade contracts, in principle, they are negotiated the same way as contracts for the mainstream market, with the same clauses and references to the European Coffee Contract and the Green Coffee Association contract. Fair trade contracts have some additional clauses. One is the minimum price, the fair trade premium, organic differential if it's organic coffee. And there's still a pre-finance clause which says that it should be 60% of contract value. In practice, what we see is that most of the time these contracts are pre-financed by some social lender, for example. Very few cases the buyer is still putting up the pre-finance. Above the minimum price applies the exchange price, which is New York or London, plus or minus the prevailing differential, plus the fair trade premium, plus the organic differential. And it must be an open contract with the price to be fixed at seller's call clause. And the pre-finance clause, like I already said, is normally substituted by finance from an external party in this. Now, the fair trade standard defines the following requisites for fair trade contracts. You can find this in the fair trade standard for traders. You sign a purchase contract for fair trade products with the producer or with a conveyor, if applicable. Contracts follow industry regulations and, as a minimum, clearly indicate the following: agreed volumes, quality specifications, price, or defined according to the requirements of the pricing section. There's a pricing section in fair trade which defines what the minimum prices are, etc. The amount of fair trade premium to be paid, indicated separately from the price. Who is responsible for paying the fair trade price and the fair trade premium? Form of payment, which must be transparent and traceable. The date of exchange rate to be used in the case of payment of the fair trade price. The fair trade premium is made in a different currency than the one defined in the fair trade price table. In the case of coffee, this is in dollars cents per pound, sorry. And in terms of amount in pre-finance, if applicable, procedures in case of quality problems, in terms of delivery using international commercial terms or Incoterms. In terms of payment, according to fair trade product standards, definition or mentioning of force majeure, agreement on applicable jurisdiction, and an alternative dispute resolution mechanism to resolve conflicts. Now, these last three are dealt with in the European Coffee Contract and the Green Coffee Association contract. So it's not it is not necessary to mention it again in your specific export contract. And both contracting parties have equal contract termination rights. It's also dealt with in the European and the GCA contract. Now, some guidance: contract signed with a producer, responsibility for drawing up the contract should be mutually agreed on. So it's not that the buyer can impose the conditions, it's about negotiating the conditions between both sides. Where no agreement can be reached, responsibility to draw up the contract rests with the buyer, who should ensure that the contract reaches the producer in an agreed language. Now, for you, that's no problem. It's all in English, but in some parts of the world, they speak Spanish and then they get contracts in English and they hardly understand what it says. Mediation is recommended as the form of alternative dispute resolution. There's a coffee help desk in fair trade. If you have any problems with a buyer or a buyer with a seller, you can always go there and ask for mediation to see whether you can get to an agreement after all. And contract with the producer should be signed as soon as the negotiations are over and an agreement is reached. That's a general rule in contract, but be aware that in international trade, even if it's only a spoken word, it's a contract. It's an agreement. Putting it in writing in signing a contract only to confirm what you already agreed. You can't step away from what you agreed over the phone or whatever, over a chat. Now, your fair trade trader standard, that's the link where you can find these clauses. Local fair trade sales contract is different from a local commercial contract. The fair trade price is established in dollars per pound at FOB level of export grade coffee. That's different from a local commercial contract where you often sell it in kilogram, in shilling, in parchment or whatever. It's different from a fair trade contract. Local sales normally are for delivery in the warehouse of the buyer, ex-works it's called, or even at the producer's farm gate, in local currency and units other than pounds, bags, kilogram, ton, etc., and without having been processed for export, delivering cherry, impartment, or whatever. Yeah. Fair trade distinguishes two types of buyers: the fair trade price and premium payers and the conveyors. What's the difference? If you sell directly to the importer abroad, this is a fair trade price and premium payer. Yeah. But if you sell it to an exporter, who in turn sells it to an importer abroad on fair trade terms, that exporter operates as a conveyor. What he does is transmit the fair trade price and premium to the producers from the buyer abroad. A local contract can be directly on fair trade terms, but it can also be a local commercial sales contract that is converted later on to fair trade conditions. And the price needs to be adapted in that case. To be able to convert the fair trade FOB price to a local price, what you need are some additional elements that need to be added to the contract into the final payment. The date of conversion to fair trade conditions, because it depends on the date, what is the price and what is the exchange rate, etc. Modification of price and costs, exchange rate of the dollar against the local currency and on what date, conversion of the local price to dollars per pound, yield to export grade from your parchment or whatever, how you delivered it, a breakdown of processing and export costs, value of grades after processing for exports, payment of the price differential. Price differential here is the difference between the fair trade price and the commercial price. This should be dealt with within 15 days. Now, the costs need to be agreed upon before in writing. the yields and the conversions need to be real and documented, not general conversions for a region or etc. And the final payment needs to show the details of the conversion from fair trade FOB price to the local price. How does the price in Ugandan shilling relate to your fair trade price put in the port? The conveyor needs to inform at least on a quarterly basis the details of each contract to the producers, which are the date, the volume, the price, the premium, the name, and the flow ID of the buyers. The fair trade price for coffee is calculated in the following way. You compare here your reference market price, New York C or your London price, plus or minus the prevailing differential. Yeah? You compare this price with your fair trade minimum price. For washed Arabica 140, for natural Arabica 135, washed Robusta 105, and natural Robusta $1.01 per pound. Yeah. Now, whichever is higher is your price. So if New York is now 125, let's say, and your quality differential is 10 cents, it's 135. That's less than 140, so you get the minimum price of 140. But when the market was up to 140 plus a differential of 10 cents, it would have been 150. So then you get this price 150 plus your 20 cents plus your 30 cent in case of organic coffee. That would be a price of 140 plus 10, 150, 170 and 30, 200 cents per pound or $2 per pound. Yeah. This is the principle. Now, in the case of local sales, you have to add to that your exchange rate, because you sell it in shilling, conversion to dollars per pound, because you're selling it per kilogram or whatever, export grade yield, how much of the coffee that you sold as parchment is exportable. You deduct from this your milling and export costs, and you add to this the value of your off-grade coffee, the coffee that is not exportable, but it's additional. It's your coffee because you're selling export grade fair trade FOB price. Even the husks are really yours. Now, in practice, there are some problems here. First of all, like I explained last week, there is an oversupply of 3-to-1 in fair trade. And the competition that, because of this, that exists, because fair trade is attractive, because of the premiums in the minimum price, they give space to a range of incompliances on the fair standards. Most common in this sense are fixed price forward sales. The producer needs to cover the cost of options if he wants to protect his position. You need to hedge your risk. Instead of respecting what the standards say, that it must be an open price to be fixed at seller's call, they say, I buy it 160, 190, whatever the price is for your fair trade, your minimum price, even if it's to be delivered months later and you still need to procure the coffee. It's not allowed according to the standards. There you need to have a joint risk management strategy. But it has a cost if you put a hedge on it through options or whatever, but normally it's through options. And that's something you need to agree on. It's an additional cost. Not apply the quality differential or apply a lower differential. It should be your prevailing differential, says the standard. But there is an issue. What is your prevailing differential? Do you really know that? What kind of grade do you have? Is there any kind of reliable reference? In case of Uganda, you at least have these bulletins of the UCDA, where they give an indication of the price, but it's still a matter of negotiation. Also very common is to condition fair trade contracts to others at a discount, what they call bonded contracts. Yeah? I buy your fair trade coffee with the premiums and etc. But you're going to sell me also a non-fair trade coffee at a discount. So really what fair trade is doing is subsidize a lower price in a different market. Could be an UTS contract, could be commercial contract. Now, discounts on the fair trade minimum price through debit notes, that's also very common practice. You sell it, you think at 1.90, and then they say, give me back 10 or 20 cents per pound. Inflating milling and export costs, very common as well. Therefore, you need to agree it beforehand. It must be real cost. Apply conversions that are not real. You've got a 90% export yield, and they only recognize 85% or whatever. Not paying for off grades. They say, I bought the parchment and those coffees are mine. Or not accepting clauses to against the standard may make you lose the business. So you have, even if it's not really in compliance with the standard, you have to negotiate the conditions. You need to secure a margin. Otherwise, you may not even be able to sell anything at all. So it's a kind of tricky business in that sense. To what extent do you stick to the standard? It should be respected, but you don't want to lose the opportunity either. And you know that others do that. Now, this is the presentation so far. Before going into the exercises, I'd like to hear from you whether there's any comment or question on this. Wilbur, give the word to anyone.
Okay. Thank you, Jos, for that presentation. For the participants, I want to welcome Maureen. I'm seeing you've joined us today, and Martha. Yes, those with questions and concerns about the presentations, where you need clarification, please unmute your microphones and give us your concerns or contribution to the presentation. Yes, Sarah. I want to hear more from ladies. Sarah, Martha. Lillian, yes, you can unmute and give us your contributions or any concerns. Lillian as well. Do you have any questions? Do you have any questions? You have none. Okay. Yes, we have new participants. Anybody with a question? Okay, let's proceed to the exercises. Yes, I think
Okay.
nobody has.
Now, I'm going to show you a fair trade export contract and a local sales contract. Yeah. First question on these two contracts is, would you sign these contracts? Second question, does the fair trade contract comply with the fair trade standards? The third question, what clauses would you change? This is a fair trade contract, similar to what you saw, but slightly different. look at this contract, all these clauses carefully, and then let me know whether you would sign it, whether it complies with the fair trade standards or where doesn't it comply, and what clauses would you change if you would be presented this contract. Then the second contract for local sales. Yeah. Would you sign this contract? Or what clauses would you change? What are the risks involved in signing a contract like this? ADC will circulate these exercises, these contracts. Now, if you have a local sales contract and you want to convert that into a fair trade contract. An example, on February 1st, 2021, you sold 400 bags of 60 kilograms dry parchment, washed Arabica, to a local exporter at 5,500 shilling per kilogram for May-June delivery. On March the 1st, the exporter calls you to let you know that he found a buyer abroad interested in fair trade coffee. It's a book issue, AA, maximum 15 defects, at a fair trade minimum of 160 US cents per pound for July shipment. September closed at 145 cents, down at 139.45 at that moment, on the 1st of March. According to the fair trade standard, what is the price differential that the buyer needs to pay you? Price differential is here the difference between the fair trade and the commercial price. That's question number 2. Now, question number 3. Negotiating a package deal. Your organization has a target to commercialize 10 containers. On March the 1st, before initiating the procurement, a buyer offers the following deal. 1 lot fair trade organic at a minimum price of 190 cents per pound, book issue AA for August shipment. 1 container fair trade conventional 160 cents per pound, book issue AA for September shipment. 1 organic at +10 for July shipment, and 1 Oats Rainforest certified at +5 for June shipment. 4 containers. Local price is 5,500 shilling per kilogram for dry parchment or washed Arabica. Your costs are 2,500 shilling per kilogram, all included to export. Yeah. Do you accept the offer? Does it comply with the fair trade standards? And what is your margin? Yep. Are these questions clear? Any questions?
Yes, hello. Yes, hello. Yes, hello. Participants, are we clear with those questions? Henry, Frank. Yes, Frank, you raised your hand, yes. Please unmute and tell us.
The questions are clear. I'm only finding out whether you do like what you did last time to avail us with the presentation and the entire presentation.
Yes, you're going to have the presentation. You're going to have these questions also in writing with some additional information. but which may help you to answer these questions, which is about where the market is and what the price differentials are and things like that.
Thank you.
ADC will share that with you after this presentation, after this session. More questions?
Okay, thank you, Frank. Anybody with another question? I think silence means that you all understand the questions and you're comfortable with the questions. Now, I would want to emphasize and tell you that once we've given you homework, please submit it in time so that we can give you, so that we can prepare very well for the next webinar and we get the right answers to all this. Some of you are absconding. We even follow up with calls and you promise to hand in and you fail to hand in, which is not good, but this is to help us understand everything that's going on. This time I expect more of you to submit, unlike last week. That's what I expect from some of you. Okay, anybody with a question? Are the questions clear? Mr. Kula, you've not said anything since morning. Edison. Abu, Samuel. Okay. Maureen says the presentation is clear for now. Thank you for your feedback. Thank you, Maureen. Frank, yes, you raised your hand again. Yes, Frank. Okay, I think nobody has a question.
Okay.
We are going to send all this work to your emails. And always look at the last slide. That's where most of the questions are. Some of you are calling in and saying you can't see the questions. After reading through the presentation, look at the last slides. That's where the homework is. Okay.
But also send it to
Yes.
Word document with all the questions and some additional information may help them. Okay. No more questions, no more comments. Then I think we can end this session, Will. Thank you all very much. And I hope to see a little bit more
Manage time.
replying on this on these exercises.
And, yes, for those who have emails and maybe they didn't receive their work, I can see some new participants. I don't think I have your emails. Some of you can write your emails in the chat box. I write them down so that I can send the homework to you. I can see some new participants. And yes, for the rest, I'm going to be sending all the work to your emails. Yes, those who have personal emails or cooperative emails, please, you can send all, we can send to all emails. There is Samuel is saying that the questions are clear. Kindly send us the presentations to our personal emails, which is okay. Yes, Martha, I've seen your email. Okay. Thank you so much, Martha. I've seen your email. Now, like we did last week, we are going to be following up on you to hand in that homework on Thursday evening and Friday morning, so that we can collect it and also share with us on Friday evening to look at what you people responded to. And then we prepare for the next webinar. Remember, the next webinar is next week on Tuesday, same time by 10 o'clock. We shall be beginning, and we shall start with the responses to the homework and a recap session. Then we go into the next session. Next week shall be talking about logistics. And I would want to thank you for participating in this webinar consistently. And also, I would want to also want to thank the people who have continued to hand in their work. Thank you so much for cooperating with us. I believe these are insightful discussions for you. Buzaya, Abu, I've also seen your email. Yes. I'm going to send it to your, yes, this is Buzaya Growers, yes. Thank you so much. Okay. I think that is it. Any final remarks, yours?
No. Thank you.
Thank you so much, everyone. You can leave at leisure. I'm going to be sending the presentations to your emails now. Thank you so much. Good day.